Real Estate Radio, Chaz Cook and Alan Spotlow of the One Team at William Raveis Real Estate, joined by Brian Skelly, the mortgage guru from William Raveis Mortgage, who narrowly made it here with us on this Saturday morning, this beautiful Saturday morning, fighting the traffic to be here to talk to us about CHFA.
CHFA.
Connecticut
CHFA.
Housing Finance Authority.
Oh, he knows.
Look at
he
that.
knows it.
It's actually on the header on this. But I did know it, but I did read it off that. Because we've many times spoke to you guys about CHFA and the time to own program. And also, what was it called? The Smart Rate Lock?
Smart Rate.
Smart Rate if you have over $15,000 in student loans.
Yes.
All
and you gotta
right.
be a first-time home buyer.
And the time to own program where you can get up to $50,000 in additional purchasing power.
25 now.
25.
They've changed
Okay.
it to
So
25.
all right. Well,
Little
why don't you
change.
break it down? Because I've got it all twisted up now.
All right, that's right. So, time to own program is for Connecticut first-time home buyers. So, if you have not owned a home in the last 3 years, you are considered a first-time buyer. If you haven't owned a home in the last 3 years, they've got several benefits going on, unique programs that have just come out in the last couple years, in addition to the regular Connecticut first-time buyer program that's been around for a long time. So, as Chaz mentioned, the one is the Smart Rate program, which I should mention they're gonna possibly run out of money for that soon. So
Okay.
you want to get a property under contract, you get 1.125, 1.125% off of the regular CHFA rate, which is pretty good to start with, if you have over $15,000 in student loans. So they came out with that program. I got an email about 3 weeks ago that they were halfway through the money that they had allocated for that special program.
Mm-hmm.
And I think it took them about roughly 2 months to get halfway out of money. So but at some point in the next month or two, they are going to run out of money for that program. In order to secure that Smart Rate discount, you do need to have a property under contract. As soon as you have a property under contract, you can contact your mortgage lender. You can contact me at scheduleloanappointment.com.
There we go.
And we'll get some of that money reserved specifically for you and for that property address. So as of Friday, the conventional CHFA rate was 6.625. So if you get 1.125 off of that rate, that would bring it down to 5.5 on the conventional loan.
That sounds nice.
If you've got over 15,000 student loans. Now, the time to own, you can combine that Smart Rate discount with the time to own. So if the stars align, you will be very thankful if you can get both of these programs. I have seen a few people do it. I've helped a couple people do it. Time to own is additional up to $25,000 in down payment assistance. It's a 0% interest rate, $25,000 loan, no monthly payments, and it is forgivable. So the longer that you keep the loan, the less of it you have to pay back. It's 10% forgiven each year. That means if you keep the loan for 5 years, you only have to pay half of the money back. If you keep the loan for 10 years, you don't have to pay any of it back. But most importantly, you can use that money to cover your down payment and your closing costs. So for example, if somebody's buying a $400,000 house, your 3% down would be $12,000. You know, the closing costs might also be about $12,000. So you're looking at maybe $24,000 for down payment and closing costs. If you get that $25,000 from time to own, that will cover pretty much just almost
everything.
All of it. Yeah. You know, you still need a little bit of money in the bank to buy a house. You know, I'd recommend having at least a few $1,000s. If you have more, that's great.
Are they still looking at reserves as closely when they're factoring all that in?
A little bit. I mean, sometimes it depends on the credit score. So if somebody has a credit score in like the mid 600s, sometimes it does make a difference how much you have in savings for the conventional option. But the FHA, they have two options. There's a conventional FHA. The FHA is pretty friendly to people with lower credit scores.
Okay.
I've seen folks get approved with credit scores in the high 500s, even for the FHA option.
Really?
So, yeah, it's a fantastic program. And they don't increase the rate if you have a low credit score where your traditional regular mortgage programs will usually charge you a higher rate if you have a low credit score. CHFA doesn't do that.
CHFA doesn't do that. And so this is the fourth time that they've refunded the CHFA time to own,
Yes,
right?
correct.
Do we think that this is going to kind of forecasting? Do we think that we're going to keep finding money to do this? Or do you think maybe 24 is just the year we're going to do CHFA time to own and then the program may go away once this last round of funding runs out?
We'll see. I don't know if they're going to fund it again, but the good news is that they just got $40 million on Tuesday.
Okay.
And so they've kind of run it. They get batches of money. Most of the previous times they've got $20 million at a time. So this time they got 40. So that should last for a while. And there is, it's kind of nice in a way that they lowered the maximum amount from 50,000 down to 25,000, because it does mean that $40 million is going to last longer.
Right.
So I would guess that would probably cover us through the spring, at least, hopefully. But it's available for a limited time. We don't know if they're going to fund it again. There are folks that have to decide to fund it. So
that is a great point. So at the max of $25,000, I just did some quick math here. So with the $40 million, if you divided that by $25,000, that's 1,600 first-time home buyers that could utilize this program. Or if we were at the $50,000 threshold, that's only 800 people. Right. So that's a big swing, right? We're doubling up on the amount of people who can take advantage of the opportunity.
Can I just say, too, there's been multiple times I've had a buyer call Brian Skelly. They, Googled somebody else and we get under contract. Said, give Brian a call and just see what he can do. Later that night, I get a text. Good news. I'm saving them hundreds of dollars. Even one time my buyer was getting money back at the closing table, which is pretty rare.
Yeah, very rare.
Alan's done a great job of saying, encouraging people, because not all banks offer the time to own program. So you have to work with a time to own approved lender. And so sometimes if you're getting approved with some of these online companies or, out of state banks, they don't always offer the program. So, and to Alan makes a great point. Not only are you getting that money to help with the down payment and closing costs, but it does also lower the monthly payment considerably, sometimes by several $100s, which that helps a lot when housing's more expensive than it's been in a long time.
Well, it's massive, because as you predicted this was going to happen, rates have gone up since we had a rate cut. So housing demand has gone up, even though rates have gone up, but mortgage applications have gone down because of the affordability factor. So with a program like Time to Own, you kind of solve a couple of those issues in one fell swoop.
Are we going to talk about that? Or
let's get into that. Man.
I keep explaining this to different people, and like every time I explain it, I keep coming up with these new analogies.
Showing year-over-year growth.
Yeah.
And mortgage demand is down.
So mortgage rates have gone up quite a bit.
6.9.
Yeah. So as of Friday, according to Mortgage News Daily, it was 6.91, October 25th. September 17th, the day before the Federal Reserve cut rates, it was 6.11. So it's going up 0.75%, almost we're getting close to a full percent. And this is really catching people off guard because, especially folks that don't, the 94 Niners listen to real estate radio every Saturday. Not everybody does. So some people aren't paying attention and all of a sudden find out that rates are higher now than they were a month ago. And that surprises people. Why is that happening? So the most recent way that I'm explaining this is it has a lot to do with expectations and supply and demand. So you got to realize there's nobody out there that's deciding what the mortgage rates are. So mortgages are packaged up and they're sold on the secondary market, similar to stock. So the same way you could buy Apple stock or Amazon, if you have a lot of money to invest, you can buy U.S. mortgage-backed securities. And so depending on how much people want to buy these things affects what the mortgage rates are. And it changes every day. Sometimes it changes multiple times per day. But how much people want to buy them and what the rates are has a lot to do with what people expect is going to happen. So if you look at what happened from June through September, the news that was coming out, the economic news that drives the markets, was saying inflation was going down most of the summer, every month, inflation going down, and unemployment was going up. So those are both things that were good for mortgage rates. So with inflation going down, the Fed doesn't have to raise rates to keep inflation under control. And with unemployment going up, the Fed starts to worry, we have to start worrying about making sure it's not too difficult to find a job. Those are the Fed's dual mandate. Those are the two things they have to worry about: maximizing employment and minimizing inflation. And so as this news kept coming out that was all good news for mortgage rates all summer, it became almost certain that the Fed was going to cut rates in September. Now, the rates that they cut is called the federal funds rate. It's not the 30-year fixed mortgage rate. It's a rate at which banks lend money to each other. But generally, when they cut rates, that the cost of lending goes down. But so what happened was, by the time the Fed meeting arrived, all of that benefit of the rates going down had already occurred from June to September, because it was almost certain that was going to happen based on all of the news that came out.
So the anticipation,
June, July, August. Exactly. So it was gradually getting better. So now, the day after, the Federal Reserve cut the rates, and pretty much for the last 5 weeks since then, rates have been going up. And that has to do with the expectation of what's going to happen in the future. So the Fed's meeting again in December. So back in, a month or two ago, it was pretty high certainty the Fed was going to make another big rate cut in December, the way things are going.
Right.
But the news has shifted. And so we had a jobs report that came out in September, and the number of new jobs created was about 250,000 new jobs. It was like double what everybody expected. Surprised the heck out of everybody. And then that shifted expectations. So folks started saying, well, maybe, unemployment's not as bad as we thought it was. Maybe it's not as hard to find a job as we thought it was. Maybe the economy is more resilient than we expected. And because of that, that has caused the likelihood that the Federal Reserve may not cut rates in December to go up, and that's shifted expectations. And until we start to see, it'll be really, really interesting to see what the November jobs report for October new jobs. That's going to be huge. I mean, in my opinion, that'll have a bigger impact on mortgage rates than who wins the election, because that jobs report is really going to say, was that just a little blip where there was just like one little month where it was off, or is this a trend that actually the economy is creating a lot of new jobs? And if unemployment stays low, there's a chance rates could go back up in the mid sevens. And, there's people that are saying that that's a realistic possibility.
I mean, we're right there. We're knocking on the door, 6.91. And, I always kind of talk about this as we head into this time of year. Like, I think a big part of that jobs report influence was just like the seasonal hiring, right? We came into that time of like mid-September, October, where now all of those companies, all those retail stores, everybody, delivery drivers for Amazon, the helpers, all of that skyrockets heading into the holidays. So November and in October, you would expect to see an increase in a jobs report because they're all preparing for those holiday seasons. And then it should kind of balance out for November and December, and then we should see a pretty big decrease in unemployment.
Well, it was more than they expected. I think some of it was expected, but it just caught everybody surprised. Like, I think they predicted 125,000 new jobs, or don't quote me on this, I'm rounding and going off of memory, but it was a lot more than everybody expected.
Right. Which, again, we can get really deep into that, but we won't, because that jobs, the way they find the jobs information, I mean, we had a correction of almost 800,000 jobs that didn't exist. I mean, so there's definitely some give and take with that information. But, I also like how you mentioned the election and how it can impact the market, which we will talk about when we come back on CT Real Estate Radio on 94.9 News Now and Stimulating Talk.